contributors to the index. Now, Quess Corp is the next company which we are speaking with. The revenue this quarter is up around 30%, but margins have dipped by nearly 100 basis points in the quarter. To discuss the FY23 outlook and the current hiring trends, we are now joined by Mr. Ravi Vishwanath, Group Chief Financial Officer at the company. Mr. Vishwanath, great to have you with us here. Thank you very much for being on the program. Before I come to what your thoughts are on margins which have dipped, have the strong trends in your recruitment business continued into the second quarter so far? What is that looking like?
Yeah, absolutely. The recruiting business seems to be on a tear. It's been on a tear for the last almost about 6 quarters now, 6 to 7 quarters. We see that moving into Q2 as well. There was a bit of a lull in Q1 when the hiring sentiment was slightly lower. But I think that has gained momentum, that has picked up pace, is actually gaining momentum as we speak. We should probably see a very strong finish to Q2 and actually build on it from there for Q3 and Q4 thereafter.
Okay. Mr. Vishwanath, what about margins which have dipped, as I said, nearly 100 basis points? Variety of things, right? I mean, there were salary increases, there was renegotiations. What's that going to look like in Q2?
I think we will start clawing margins back up. I mean, this is the lowest it can probably get to. I don't think it can get lower than this. There are some long-term investments that we've been making into, which are also actually being charged to the P&L account, and those should also start yielding results from Q3 onwards, not immediately in Q2, but from Q3 onwards, those should start yielding results. So overall, I would say we've kind of bottomed out as far as margins are concerned. All our businesses have turned around admirably well. There's nothing that's actually a cause for concern, except, of course, the operating asset management vertical or the segment for us, which still continues to give us some sleepless nights because officers are still not back to how they were functioning pre-pandemic. I think once that comes back to some kind of normalcy, we will see we will see the margins definitely inching upwards from here on.
Management vertical is giving you sleepless nights. What about the other two verticals, workforce management and global technology? What kind of growth do you see there, and what would be the triggers?
Workforce management has been a rock star for us for many years now. I mean, I won't even take quarters. It's been a rock star and will continue to be the pole star for us. Actually, the sense that that's a business that has immense potential. The addressable market is large. We are the market leaders, and we will not be giving up. We will not be ceding any space in this particular segment in the general staffing business to anybody else, because we're clearly market leaders, and that continues to be on a roll. So that will maintain the same kind of growth, or the same kind of momentum into the future as well. We're only gaining from strength to strength. Global Tech Solutions has been a very interesting part of our journey over the last few years. Has been a surprise package. And we will see. The call center business, which is Connect, has been on a tear. Has been on a tear for the last about 6 quarters now, and continues to maintain the same kind of momentum. That's good. Allsec, which is the HRO business again, has been doing admirably well. So between these two, I think, and of course the InsurTech platform of MFX has also been keeping pace with the other 2 businesses in the vertical. So nothing much to complain as far as Global Tech Solutions. We will maintain. Margins, I don't think will improve dramatically from here onwards. I think if we can maintain the same kind of margins as what we have currently, I think we would have done a pretty good job.
Okay, so you told us about the margins and your growth targets, but you didn't give us any numbers. What is FY22? I think your revenues were about a little under 14,000 crores. What is the expectation for FY23 and 24?
You should probably look at the same kind of growth as what we've done in the past. I don't see any reason why the top line growth should be impacted in any manner whatsoever. The top line growth will continue to be will be good for us. The margin improvement, again, like I said, from Q1 onwards, from Q2 onwards, you will see an uptick in the margins as we move forward. So I think overall we are in a pretty good spot right now for me.
In the product-led segment, will losses continue to come down? I mean, what's the guidance there?
the losses will not continue to come down for the current year. The losses will be at the same levels for the current year. By about Q2 or Q3 of the next year is when we expect the losses are coming down, because these are investment phases that we are into. We raise capital for investment into sales, marketing, and product development, and so we will continue to invest in those very heavily, both this year and in the early part of next year. So by about Q3 and Q4 of the next financial year is when we will start seeing it break even and kind of improving thereafter.
So, the margins continue to be a spot of bother, right? You said that although the worst of the margin pressures is behind, you may not see too much of an improvement from here, but you do have an aspirational target of 6% EBITDA margins, which is still low single digits by 2025. Do you stick to that, or would you change that? And why is it that despite a pickup in the business, the margin profile just doesn't seem to change?
The margin profiles have been impacted. Every now and then we have something impacting us. For example, the losses in the product-led businesses are not small. I mean, these are fairly significant amounts that we are investing, and these have impacted margins. The renegotiation of a large customer contract for us has led to a margin dip. So, but for these, I think overall, margins seem to be reasonably on track actually for that. So I don't see any cause for concern. If you just take the product-led businesses out, I think we should be able to get back to decent margin levels by about Q3 and Q4 of the current financial year.
Okay, just one final question. Do you have any plans to sell minority stake in Monster in order to sort of unlock value?
We did that, right? We raised external capital in Monster in January this year. We brought in external investors who currently own about 10% of the total cap. Of the total cap table is actually with external investors. And if some more money needs to be raised, we will not shy away from it.
Right, Mr. Vishwanath. Thanks a lot for joining us at Quess Corp. By the way, on the market, the sector of the day now is the non-lending